and I like to give people a chance to get into the room. So everybody knows the process. If you can just look on the top of your screen where you see chat Q&A in the chat area, if you can tell me where you're from, it lets me know that you can hear me. Barry, I expect to see you're from Parsippany, and if for some reason I don't see it there yet. Can they hear us? Colleen, if you can hear me, put something in the chat. All right, thank you, Barry. First one, hey, Ken, still in Totowa too. Great. All righty, so people can hear us, which is good. We will get started in a second. Want to make sure that we get more people into the room. Now we're summit. So most people I see, Okeechobee, Florida. So Ron, I was just down in Florida. I came back last night and I was telling our speakers, Monica and Allison, how different a world it is down in Florida. It actually felt normal to some extent. And mainly it felt normal because there were lines at Disney and it cost a lot of money. So it felt more than normal down there. But no, it actually felt there was some normalcy and it was really enjoyable. So, so it's been a while since we all got together. I know that people do watch these via recording, and we have been playing the Sobel Insights, which Monica actually was on one recently. So I recommend you view those in addition to these past recordings. So I just want to remind people that if you have any questions, that they should go into the Q&A tab because I focus on that more during the presentation. If you have a discussion, that goes in chat. But please don't put the questions in the chat function because sometimes they get lost. If you are attending this for CPE, we will have polling questions throughout the session. And to just make sure that everybody remembers how to do a polling question, I'm going to do a polling question right now. Are you familiar with any of the valuation or appraisal organizations? That's certified business valuation analysts or appraisers. So if you can answer that, we usually leave the polls up for a minute. Approximately a minute or until I get around 90% of the people. You do have to answer, I believe it's 2/3 of the polls. Yeah, 2/3 of the polls to be able to get CPE. We will put up 4 polls. I never understood why some organizations put up 3 polls because if you have to answer 2/3, if you miss one, you're automatically out. So I do 4, and you could, if you miss one, unfortunately, because you run to the bathroom, you can still get it. So it looks like 39% said yes, they're familiar. 37% said I'm somewhat familiar, but really don't know the differences. 23% said I'm not familiar, and 3% said it doesn't matter to me. I think that one person is going to the lowest price vendor, maybe. Don't know. Anyway, so let's close out the poll. I think that's enough time. So today's topic is on valuations. Business valuations, asset valuations, appraisal, and real estate valuation. We have 2 very, very well-known and comfortable speakers, Monica Caden and Allison O'Malley, both with Sobel Co. Allison O'Malley's with Sobel Valuation. I'm sure she'll correct me later on, and rightfully so when she comes up, but I'm going to kind of hold her off because I know she's going to be all anxious to just correct me finally. So, Monica, let's you and I start talking to get Allison a little mad that I'm not letting her correct me yet.
Okay.
Let's talk about business valuations, and you and I actually have been working on a business valuation process currently. Of course, we'll leave any of the personal information out. What is the backbone? What is needed? Why do people get business valuations that you see?
Okay. First of all, hello to everybody. Glad to be here this morning. People do business valuations for a whole host of reasons. For estate and gift tax purposes, if somebody dies, if somebody's gifting an interest in their business, buying and selling. We're doing a tremendous amount of owners looking to sell their businesses, looking to sell an interest in their business, companies looking to do acquisitions. So a lot of buying and selling. I do a lot of litigation work. There's a lot of valuation that's involved with shareholder disputes and matrimonial disputes. Financial reporting, purchase price allocations. One company acquires another. You have to value their assets and put them on the acquiring company's books. So purchase price allocation work, 409A valuation work. So we run the gamut. There's a wide breadth of different types of valuations. And we at Sobel do have people who specialize in different areas and different industries.
So a while back, I think it was our last actual CFO roundtable, we had, it was on business transactions, buying and selling a business. And Alan Sobel made a very interesting comment. He said, your business should always, it doesn't have to be for sale, but should always be on sale. In other words, you should be considering it. Do you recommend that people, if they get a business valuation, now, of course, I'm just talking about a sale, but it could be for many other reasons, as you just said, should people regularly get a business valuation and then update it throughout a course of time?
Well, that's an interesting question. Certainly, if you're starting to contemplate a sale and you want to have an idea of what's a reasonable fair market value of my company, you're going to do a valuation. Obviously, if you're an ESOP and you need to do that annually
Right.
for ESOP purposes. For setting up a buy-sell agreement, which I'm doing one right now for a major law firm that actually doesn't have a partnership agreement, which is surprising because they're all lawyers. But this is an instance where even to understand if they need to come up with a formula for a buy-sell agreement, they're going to do a valuation. They're going to have some multiples that we'll come up with, maybe a multiple of earnings, multiple of revenue, multiple of gross profit. And they may want to do that to set up a buy-sell, and then periodically, every few years, want to update that. So there are reasons internally that a company would want to do valuations more often. And you know, it's a very active market right now. I can say we're doing a lot of valuations for companies that are being approached, that are interested in being acquired. So we're doing a lot of M&A type valuation work right now.
Yeah, I mean, I find it very interesting that, you know, people own stock, IBM, you know, stuff like that. Obviously, you know what stock is. I don't know if I have to educate you on stock. I'll go into bonds next and talk about them. But no, people understand the value of their portfolios, their 401k. Allison will talk about real estate later on. Everybody, you know, if they live in a townhouse condo or whatever, they know what the guy next door is selling for. But it's amazing they never know, not never. A lot of business owners don't know what their business is worth until an activity happens. You know, divorce, you know, death or something. And it's unfortunate that they do wait for that one-time event, and then they're scrambling to get you know, evaluation.
I think something that's important, and I know that it's something that we were going to discuss, but that if a company decides they do want to get a valuation or they do want to go down this road, that they want to make sure they're dealing with somebody credible, somebody who has credentials. We'll talk today a little bit about what those organizations are that certify appraisers. And there are a few of them, and they're reputable, but you don't want somebody who doesn't have a valuation credential doing your business valuation. Especially if you're going to get into a situation where there's potential litigation and it's going to really have to hold up. And if it's a valuation that's going to go to the IRS for estate or gift tax purposes.
Right.
So, you know, I know we're going to get into that, but, you know.
So on performing evaluation, because, you know, of course, the CPA is a trusted advisor. We feel comfortable with that, but you have to know your limitations. And of course, a client called me and said, well, what do you think my business is worth? Why, you know, it's not your business. So of course, I do a traditional EBITDA calculation because I can do that, you know. And
you got to normalize it first, though, Brad.
You don't talk these crazy terms. But I just did a simple EBITDA calculation, and I took 357. I said, I don't know what the factor of your industry is. I didn't normalize this. This is just a straight EBITDA calculation. It took me, you know, an hour to do it took me more time digging the numbers. But that's the point that I could take it to. You need somebody involved that does these. And I mean, what I just said I did is, I mean, you're laughing at it inside because it's such a kindergartner. What do you do when you're doing a business valuation? Because people think it's just what I said. Oh yeah, just take the EBITDA and multiply times 3, 5, or 7, whatever the multiple is.
Right.
I'm sure it's a lot more.
It is a lot more. And I think people today in the audience know that there are different scopes of work that we can do when we're engaged. So we don't necessarily have to do all the approaches, which I'll discuss. You might decide you just want one approach, and I've had that situation recently. But let's just talk about what the main approaches are. There are 3: the income approach, the market approach, and the asset approach. The income approach is where we're going to look at a company. We'll probably get a 5-year history, either tax returns or audit statements, or we've used internally prepared if that's all that we're going to get. And we're going to normalize the earnings of the company. We might, we'll look for any discretionary expenses that need to be removed. We will maybe do an officer compensation adjustment. If an officer is making $900,000 and he wants to go lay on the beach, and you could pay somebody $300,000 to do his job as CEO, we'll make that adjustment. So we normalize the earnings. We develop what's called a cap rate or capitalization rate if it's a 1-year model, or if we're doing a multi-year model, we'll do a discount rate. And basically, based on the normalized earnings of the company, we can develop a value. To make a decision, are we going to do a look back and based evaluation on a look back, which we think is a good proxy for going forward, or are we going to do a forward-looking discounted cash flow where we'll show 5 to 10 years with varying cash flows going out to a steady state? So we kind of have those 2 options within the income approach.
So I know that Allison uses similar approaches. And I mean, are they exactly the same, the 2 approaches?
Not quite. The concept is the same, but I can use different information. An income approach for a real estate property can be based on market rents. So you do research on recent leases that were put in place and you cap the NOI of a market rent. Or you can do what Monica does for a business valuation and take 3 years, 5 years, or 10 years of income and expenses, normalize that, and either apply a cap rate or a discount rate to that to come up with your value.
Okay, so what you guys do, I mean, I know that you're specialized in your areas, and I'm sure that there's some sort of crossover, but there are similar approaches that you do. Ron actually asked a very good question. And it's good for, I think, him and I, the 2 of you, probably can say that's an easy answer. How do you value a pre-revenue company with intellectual property in the form of trade secret?
I think at the end of the day, well, you could do 2 things. One, you could, come up with some sort of a forecast of what you anticipate will be your revenues. So you could do some sort of forward-looking forecast. The other option is, if you're really trying to get down to valuing intellectual property, this is saying, how do you value a pre-revenue company? So not the intellectual property itself, but the company. So if you were valuing the company, you might need to do some sort of forecast. What sort of market share are you going to get? What might be a reasonable forecast of revenues and potential earnings, and discount that. When we're valuing intellectual property itself, it's going to be based on a revenue stream, a royalty rate, and present valuing that royalty rate. You can also value intellectual property with the asset approach, looking at, let's say you have software. How much time did it take for a developer to develop the software, write the code, go through quality control, etc. So we can do a buildup of the costs. So, but I would say mostly a forecast.
So that's interesting. So if it's a business valuation, you're involved with it more now, but if it's intellectual property, does that slip into an asset appraisal, or is intellectual property not as much an asset appraisal?
No, intellectual property is an intangible asset, so it's intangible asset appraisal.
Okay.
Probably it would fall into our domain in business valuation. You know,
Okay.
I've done a lot of intellectual property, patents, trademarks, and the typical way that it's done is called the royalty relieved method. You're relieved from having to pay a royalty, and it's a royalty rate that's applied to a revenue stream that's going to be generated from that intellectual property.
So both you and Allison rely on, I heard you say, forecasts or projected cash flows. I imagine, Allison, especially with real estate, you're looking at the leases and projected cash flows. Real estate, I think, is easier. I actually do a presentation on prospective financial statements, which is forecasts and projections. And I don't know if you know, the first footnote in prospective financial statement says this information is a guess and more than likely it's not going to happen. How comfortable do you feel? I know this question's out of left field. How comfortable do you feel with prospective financial statements that you get from management? Do you have to beat them up? That Alice, I'm sorry.
It all depends on if their forecasts go along with the past income and expense that they gave us. If they give us 3 years worth and their expected income is 100,000 a year, and then their forecast jumps it up to 250,000 in the 5th year, we're going to question that. I've had situations on shopping centers where, you know, for 4 years, their snow removal expense is only 2,000 or 3,000, and then it jumps up to 18,000 1 year. And you have to look back and see, was that a big snow year? Why did that increase so much? So you have to question them on certain things that become outliers in their forecast or in certain years. But as long as they can explain those in a way that we understand it and it seems reasonable, then we trust the information given to us by the client.
Right, because I, as the accountant, can prepare a prospective financial statement and, you know, and not be called to criticize, whereas the valuation people that are relying on that information to perform their valuation, you push back and have to push back very hard on people. And I try and tell people that perform or prepare prospective financial statements, you got to be realistic. Stop with these jumps in sales and these cuts in expenses that are not going to probably happen.
Right.
Because it's just going to be embarrassing, not only for, listen, I prepare and I just hand it over, but it's going to be embarrassing for you when people start questioning, and the business valuation person is going to be very uber critical of this. So I'm just looking at the time. I'm going to put out one more poll, and I did see a question come up. So let me just send out a poll real quick. In your work, have you ever had to be involved with the business valuation? If so, for what purpose? So we're going to send that poll out. If you can look through that poll. I think that somebody asked a question, but it looked like it was pandemic related. We're going to get to that. Monica, before we get to some pandemic stuff, I don't know if you know that some stuff happened in the world over the past 16 months. I'll explain stock to you, and then we'll explain what happened over the past X amount of months. But you had mentioned before, and our poll asked about credentials. Are there certain credentials that people should be looking for when they're looking for a business valuation, asset appraiser, real estate appraiser, or should we just go to, you know, Walmart's and find the cheapest and the easiest? Not picking on Walmart. I think that's valued at around $100,000. Walmart, by the way.
So your question was on credentials, Brad? Is that? So there are several organizations that provide valuation credentials. There's the American Society of Appraisers, and you can become an accredited senior appraiser. There's the AICPA, which many of you are familiar with who are accountants, and you can be an ABV, accredited in business valuation. There's NACVA, which is the National Association of Certified Valuation Analysts. And you can get a CVA, Certified Valuation Analyst. Those are the main organizations. There are some other international organizations. So if you go to another country, that you might see some other designations. But I would say somebody who's an ASA, somebody who's an ABV, somebody who's a CVA, you would want them to have those credentials. They've gone through the training, they've submitted reports for peer review, they've had a certain amount of experience they've had to prove, and they're going to have a real methodology in their reports that they're going to follow. So it would be, I behoove any, it benefits everybody. Especially, I've had litigation settings and, you have somebody who's just so way out there. It just doesn't help the parties. It just doesn't help, resolve matters. So having somebody who's credible is important.
And Allison, I believe there's similar ones. I know for real estate, because my daughter is in real estate appraisal, and I strongly encourage her to continue. But I can't believe the process that you have to go to be a MIA. Is it MIA?
Well, MAI is after you get your state license. Just to get your state license, it's 300 hours of education, 3,000 hours of apprenticeship training to be able to do commercial and industrial.
Wow.
Yeah. And then the MAI, it'll take me probably 5 years to complete that certification. And that includes another 300 hours of classes, mentoring under an MAI appraiser, and then taking a humongous test and writing a very involved report.
Okay. Now,
and that's through the Appraisal Institute that helps the Appraisal Institute and the Appraisal Foundation work with state regulatory boards to come up with the guidelines that we follow, which is USPAP, the Uniform Standards of Professional Appraisal Practice. And they work with even the federal government to get items passed on how we have to perform our jobs. So we're very regulated in real estate.
Okay. So, and I imagine asset appraisal has similar credential criteria that people are trying to achieve, right? I don't know if it follows.
It follows more the business valuation model. You don't have to have a state license, but the ASA and Appraisal Institute offer courses to accredit you for asset valuation.
Okay, great. So now people know who they should be looking for. I mentioned before, and somebody actually asked a question, Eugene asked a question about it. We've had the past 14 months, and I know as part of our information we received from the AICPA as accountants, auditors, taxes, tax advisors, business consultants, we are constantly reminded that a pandemic happened and it has affected the businesses. How are you treating this whole pandemic, this whole COVID? Are you and PPP and ERC and shuttered venues? I'm going to see Chris Martin. Come on, give me some more. All these different things that have been going on. How are you taking that into consideration as relates to business valuations?
Okay, I'm going to answer that question. I just want to step back for a second. And I don't know if you were planning to go back and forth with Allison and myself, but the other two approaches besides the income approach, I just think it's important for people to know that there's a market approach where we're going to look at market transactions of similar type companies. We're going to look at their market multiples in, let's say, an acquisition and apply it to our subject company. So that's a market approach. And then we also have the asset approach where we're going to look at the balance sheet of the company, and we're going to look at all of their assets and liabilities and gross them up or down to fair market value and make sure we've captured any intangible assets if they're there. So the three approaches that everybody should know about are income, market, and asset. So back to your question, Brad, on COVID, very interesting. I mean, I think the most important thing that business evaluators can do right now is when they get a valuation and we have a look back of information and we may see 2020 tank. I just did a bunch of grocery supermarkets in 2020 looked pretty good. And so it's very much by industry. I've done healthcare practices really, really bad. March, April, May, June, and then they started to normalize. in the fall. So I think the main thing is to, understand the past and then get a sense from management or the owners, what do they think is going to happen this year, 2021, next year? And we may do a more involved model. We may do a discounted cash flow. Maybe we'll show them going down this year, next year, level off, and then start to grow. So I think we're seeing, we're having to do more forecasts into the future. Sounds like somebody says I'm breaking up, that you're not hearing me well. So
yeah, Ben said
me, Brad?
that. I'm hearing you. Sometimes you cut in and out, but I'm hearing you.
Okay.
Content.
Apologize for that. But I think the main thing is the way that we're handling it is that we have to be more thorough in terms of questioning management, understanding what's going to happen going forward. Because what has happened in the past, some businesses may not recover. You may be going into a situation where, maybe it won't be a going concern in a year or two. You can't really look at the past. And then you have other situations. I have a lot of healthcare entities that are now pretty much almost back. I have surgery centers that are almost back to full where they were. I have medical practices. I do a lot in the healthcare space. And I have some businesses that really just weren't negatively impacted. They may actually go down. These supermarkets, I have a whole bunch of supermarkets that have done very nicely during COVID. So
have you worked on any hospitality in any way or entertainment? That's a good
question. Not recently, not right now. Like I haven't done a restaurant. And you couldn't just do your straight look back the way we normally would, for sure. It would based on, this is the level of profitability they used to have. Let's do a forecast, and we'd probably go out several years.
Right.
And do different models and different scenarios.
I mean, Frank Miranda sent out an article one time about showing when different industries were expected to recover. And I think it said hospitality like 2024, which I mentioned my daughter who does real estate appraisal. My other daughter is in hospitality. So I have one on each end. It's working great for them, at least one. So as it relates to PPP, ERC, shuttered venue grant, the New Jersey EDA grants, how do you take them into consideration when you're doing evaluation? You have these loans that are out there that are supposed to be forgiven, or these grants they've got. What do?
We show them on the balance sheet. I mean, they exist. They're there. We may make the assumption, if management feels very confident that they're going to be forgiven, we're not going to reduce their equity by the amount of the PPP loan. But it'll be disclosed in the valuation. The loan is there. Management believes it will be forgiven. The question comes, we can do these weighted average cost of capital discount rates or cap rates that are a blend of your equity and your debt. So now you have debt. But you haven't historically, maybe your company hasn't historically had debt. So are you going to factor in this loan that is likely going to be forgiven, and should it impact their cost of equity, their discount rate? And I would say no, not when if management thinks that it's going to be forgiven, that is the way that we would treat it, but it would be disclosed that it is there.
And if they have forgiven it, because I'm an advocate of IAS 20 of getting this off the balance sheet, not for any nefarious reasons, I just want it off the balance sheet. If it is forgiven, I imagine that's a normalized
yes.
for EBITDA.
Yes.
They'd like to leave it in the income.
Yes. Oh, in terms of the income. Yeah. Absolutely.
So, I mean, I thought you had mentioned all of the three approaches the first time, and Is there, I'll say it one way that I've heard a client say it, and it's almost like an insult. Is there a business valuation light that people should be doing? Or, you know, are there different levels of business valuations?
Right, right. Well, as you know, Brad, we're an accounting firm, and I am an ABB, and I do follow the AICPA's guidelines. And the AICPA came out with the statements on standards for valuation services, which really provides for two different scopes of work. We have a valuation engagement, which is the that's a fully loaded report. You have all the different sections. It's the most expensive. You get all the approaches. You get your ratio analysis, economy, industry, the whole kahuna. And it's a more expensive proposition. And then you could say light. The light version might be is the calculation engagement, which is more reduced scope. So if management wants to get a sense of what's a reasonable value of my business, I'm being approached. I don't need the rate. I don't need, all of the extras, the economy, the industry, the ratio analysis. I just want the approaches. We can do that. It's called a calculation engagement. You, for the most part, get all the approaches. If you only want one approach, we can discuss that. And it's less expensive. It's not a giveaway. It's not a back of the envelope analysis, obviously, but it is a less expensive option and a good option. We do a lot of them. I'd say good 70% of my work is calculation.
And that goes back to my question I asked early on, where I said, is it beneficial to get a valuation done now, or let's say now as a starting point, and then every few years update it? I imagine it would be, you're still spending money, but you're not reinventing the wheel every 10 years and having to, because the information from 10 years ago is really not relevant then.
Right. Absolutely. I mean, if we do a valuation in 1 year, if for any reason, you want to have an idea of what your company's worth, and there is a lot of M&A activity out there. You might say, oh, my company looks great. This is the right time right now. And you're right. If we're going to update it in 2 or 3 years, we're just going to update. There haven't been major changes. It's not going to be that much to do the update. It's kind of that one time get to know it's like an ESOP. We get very deep when we do that first ESOP valuation. And then if there's not much change, it's just kind of updating the annual information.
So that's one question I want to ask Allison some questions. The other people that are involved in this process, you'll reach out to me if I handle the client, or other people in our office for information. But the CFO, the controller, a lot of this falls onto them. What should they anticipate when they're going through a business valuation?
The controllers are the best. They're a window into. Thank you to all you CFOs out there. We put together a document request list, and it usually starts. We will start if it is a client that's in-house. We will start with our in-house staff to see what information we have. And then we go to the CFO, and we have a document request list, and it'll be, 5 years of tax returns, financial statements, accounts receivable, inventory reports, leases, partnership agreements, operating agreements. We have a standard list, and the CFO would be the one who would get that list and maybe organize if he or she doesn't have it, where to go to get that information. Maybe it's the outside accountant. So.
I'm sorry, I was on mute because I thought maybe I was cutting you off. I'm going to put up another poll real quick, and I want to say something. I know in a second. What type of industry is your business? So while people are answering that, I will say as an auditor, and at Sobel Co. and Allison and Monica at Sobel Co. Occasionally, Monica and Allison get called into our clients to do some valuation work, and I as head of audit, I start to panic because we have a threshold of independence that we have to maintain as the auditor. If we audit financial statements or review financial statements, somewhat was compiled, but we could talk about that another time. I will say, as the auditor, people answering this poll, we cannot have people, a valuation person, I'll leave it at that, perform a valuation that will ultimately impact the financial statements. So generally, if the business valuation is for divorce, it's for estate and gift, or potential sale, that will not impact the financial statements that we are involved with. Now, if somebody is buying a company and Monica's bought in to value the assets, not the value that, to allocate the purchase price, or Allison is bought in to do some evaluations, especially when it comes to impairment. I'm going to hit you on impairment, Allison, in a little while, because I love that. That could potentially impact the financials. So you'll see us have to pull back and refer somebody else. So Allison, we've heard what business valuations are. How do they differ from asset appraisals and real estate appraisal? Or say it another way, what are asset appraisals and real estate appraisals?
Well, I think that a real estate appraisal and an asset appraisal are quite different from the business. The business, you're looking at numbers, activity. For real estate and machinery and equipment, we're going to look at something specific. A piece of property, a piece of equipment, and we have to look at that and use our approaches to come up with a value for that. And no matter how many times Tom in our office tells me, oh, this is just a standard industrial building, there are no standard pieces of real estate. There are no standard pieces of equipment. It turns out everything has their little
nuance
differences, and you have to take that into consideration. So inspections are big. We like to go out. We want to look at the property. We want to look at the piece of equipment, see what exactly we're valuing, to be able to compare that to others out in the market. We want to look at the lease, if there's a lease on a building, whether it's an in-house lease, the owner is actually occupying the building, but they have a holding company and a lease to that holding company. We're still going to analyze that lease for an income approach. You also have a cost approach for real estate. Right now I'm working on 5 different property appraisals. 4 of them will be a sales approach and an income approach. The 5th is going to have a sales approach and a cost approach because it's a specialty type property. We have to determine what the replacement cost of that building would be and then depreciate that to come up with a value, because there's nothing else to compare it to in the market.
Okay. That's very interesting, because listening to you now, it kind of put into perspective for me that, and I'm going to summarize it, and I know I'm completely going to kill what you just said, but the way I look at it now is that Monica is looking to determine what the value of a business is. If somebody wants to do a transaction or an activity, a lot of times I imagine that the real estate and machinery equipment, you're called in because this underlying asset is supporting something else. A lot of times debt, I'm sure. And there's somebody that wants to verify that the value of the property exceeds the debt that's out there. And I imagine there's other reasons too. The COVID situation, has that had a big impact? Because I think Lee actually said, Lee gave me a little dissertation in the Q&A, even though I asked for chat and chat. Anyway, thanks, Lee. We work with Lee. Has COVID impacted real estate appraisals and machinery equipment? And I know you're going to say it depends.
Real estate for sure.
Okay.
We're seeing industrial vacancy rates at a low that has never been seen before. You can't keep up with the demand on industrial, especially large warehouses, storage warehouses, distribution warehouses like Amazon and Wayfair, cold storage. They're huge right now. Multifamily, surprisingly, has had high demand, and the market is a little shaky there because some owners are losing out on rents because of COVID and associated fees that they would typically correct. But even CBRE's most recent report said they expect that to recover by the end of the year, and multifamily will continue this high demand that we're seeing. I pulled some numbers. North and Central Jersey for industrial space has a 3.5% vacancy rate in northern New Jersey and a 2.3% in central New Jersey. And asking rents have been going up even with COVID.
For light industrial.
I'm sorry?
Light industrial?
That's for industrial in north and central Jersey. Now, retail has tanked all over the country. But last month, I worked on a business valuation with an outside appraiser, and I had to call brokers all over the country. When I spoke to a broker in Vero Beach, Florida, she said retail construction is booming down there. The new have laptop will work work model, people are leaving high tax states and moving to Texas and Florida, and they can't keep up with the population growth, and they're building new retail centers and they're building new office buildings, and the industrial is also going up. So it really depends on the market and where the population centers are now. Currently in North Jersey for offices, the vacancy rate is 20%. Huge. Central Jersey, it's a little lower at 19.1. The highest demand in office is for financial services and business and professional services. And asking rents have remained pretty much flat. And nobody knows what's going to go on with the office because it looks like work from home is going to stick around for a while.
Right. So, and that's what I've been hearing. The one thing that I found interesting is that I heard the high-end malls are actually doing okay because people couldn't take vacation, so they were spending their money there. You know, what I refer to as the Garden State Plaza up north, or the Mall of Millennium, Florida. Yes, I know the whatever American Mall of America in Meadowlands. I don't know what's going on with that, but that's besides the point.
I live 2 miles from King of Prussia Mall, which is one of the biggest malls on the East Coast, and it is packed every day, door to curb. There are people shopping, and they're coming in from all over.
Wow. Ben asked the question about the New Jersey office vacancy rates. You said at 20%. How were they pre-COVID? Comparison, if you know.
I don't have that number on me right now, but I can certainly get that number and get it back to Ben.
And I know Ben has an office in Parsippany. At one point, Ben, I know Parsippany was at 10%. But we're getting hit right now. So Allison, so equipment appraisals, you know, I'm very big on impairment because I'm an auditor, and one of the considerations we have to think about during an audit is impairment of long-lived assets, especially real estate, but machinery and equipment. You know, I have a client that has big ovens, refrigerators. That's significant equipment. Are you called in, or have you been called in the past to do appraisals for long-lived assets?
I have been called in, but not to do an impairment value.
Okay.
I have not performed those yet. I'm still in training for the asset appraisal under Lee, who had spoke on in the Q&A about machinery and equipment values. He would know more on the impairment values. I've gone in and strictly done market value on, say, landscaping equipment or machine shop equipment. Just what is the market selling for at this point? Okay.
Yeah, because as an auditor, if we see a triggering event, that's vague, but it's usually a downturn in income, a situation, COVID, we have to consider if there's an impairment of long-lived assets. So for those companies out there that have a lot of long-lived assets, and by the way, I think it was Lee or Monica or both of them said, intangible assets are long-lived assets. You do have to consider those for impairment also. So I'm saying that as an auditor. We do have a couple questions that came up. Allison Ken says, do you know what the vacancy rate is for retail? I see a lot of empty stores everywhere.
I searched over the last week when the Q1 2020 reports came out. I have searched for a number on retail and have not been able to find any specific number in the area for retail. They're expecting some areas of retail to bounce back, but no numbers have been put out for the first quarter yet.
Really?
Really.
John asks, and I don't know if I have this all right. I'm going to try and read it real quick. What is the approach a valuation should take when using DCF, discounted cash flows, right? I couldn't figure out what it was at first. I'm reading it. All right. Anyway, welcome to my world. What is the approach a valuation should take when using discounted cash flows about change of use? If historically it was retail, can we modify for something else that has a better outlook? So what valuation approach, I guess, would you take if you're going to have a change in use? I don't know if Allison, go ahead.
So I'm actually working on an appraisal right now that is sort of like this question. Originally, the building was a flex building. It had some finished office space, some high bay warehouse. It had been converted strictly to office about 10 years back, and they are now converting it back to a flex property. So for that particular appraisal, I'm using the market approach. I'll compare the building to other flex properties in the area, making adjustments for fit out and the cost that it will take to revert this back to a flex building. And then we'll do an income approach based on the leases in place.
Okay, great. I'm going to put a poll up in a second or two. Dale asked a question, is this a good opportunity to do a low valuation for gifting stock ownership to shift ownership to Sun due to pandemic? Now, I mean, I think that they're saying shift due to the pandemic situation, not because the Sun has pandemic. Okay?
Right. I mean, if the company is not doing as well, as we said, there are some companies that were actually potentially doing better. So if you're in a situation where your company is not doing well, yes, it would be valued most likely lower than it might have been pre-pandemic. And then obviously an equity interest. If it's a minority interest, we would apply a discount for lack of control and a discount for lack of marketability. So, that's if it's a minority interest, which likely in a gift it would be. So yes, it would be a beneficial time to do that. Mm-hmm.
And I would also recommend that they talk to their tax advisor. Nothing against Monica, but as to the gifting and everything, coming up with anytime you can come up with a low value is usually good, but I'm also an auditor. I recommend you talk with somebody that's in the tax area. So I'm hearing what the both of you are saying. I want to make sure that I and of course the attendees have a good understanding. So Monica, I'm looking at buying a business that it's $10 million, $20 million, whatever, just throw any number out there. And it has a lot of equipment, maybe real estate in there. Are you generally operating in yourself in a vacuum with Becky and Megan? I'm just going to mention everybody I know on that side of the office. Are you operating on your own, or are you calling in people like Allison to get their input as to the value of the equipment? Because that's the one thing that I deal with as a difficult situation as an auditor. And I know I'm speaking as an auditor, but I can see that the owner's saying this because I have to go to the owners to ask the question. They bought the business for $10 million. I say, okay, what was the equipment worth? What's the real estate worth? What's the intangible? how do you come up with this breakup of the value between the different assets? And do you interact with Allison, or is it you operate in this area only?
Right. Very good question, Brad. No, I do not operate in a vacuum, and I absolutely call Allison or Lee also, who's on the line, I believe, who does machinery and equipment, and Allison does a lot of the real estate work. One, when we're doing evaluation, let's say we have a company, and the company has a building on their books. They actually own the building. What we would do when we're valuing the business is remove that asset. We remove that building from the analysis. That asset should be valued separately. So we would call in Allison. She could value the building. One, in the business valuation, we need a fair market rent. What would this company have to pay in rent if it was a third-party lease? And we would get that from the real estate appraiser. And we also want to take out any expenses in the business valuation that have to do with the property. So that asset would be valued separately. Now, it's important to know about the machinery and equipment, because one of the approaches we're going to do is the balance sheet approach. And we would want to know how to allocate, the values of all the separate tangible assets of the company. Especially if you're in a situation where you're going to be in an acquisition and this is equipment that is going to be purchased and then potentially depreciated. What is the value? Or if there's this cost segregation work I know that we also do, where you can classify the different types of machinery and equipment to get the most advantageous depreciation. So it's very worthwhile. We don't always have business owners that want to sign on to the M&E right away if they don't see a direct value for it, but there certainly is. In understanding your assets, understanding, cost segregation, and if you're in going to be acquired, what would be the value of your machinery and equipment that you could pitch to a potential buyer? So I have several valuations going on right now where Allison's involved and Lee's involved, and we work as a team, one-stop shop, I call it. And I do honestly think that's a nice thing about Sobel, because a lot of firms do not have business valuation, real estate, machinery, and equipment all in one place. I've been doing this 25 years in New Jersey, and I think Sobel is the first firm where we offer all three, which is very nice. It's basically one-stop shop, and we can be more efficient and, better on fees. So anyway, did I answer your question?
I'm sure everybody's listening and saying, what a question. I can show you my questions I have written down. That was not planned at all. I honestly did not know that the two valuation processes interact so much and coincide. That's great. Now, you mentioned something that I found very interesting. You said the words twice. You said cost segregation study. Now, I get involved in that a lot because as a tax process, people want to get as much bonus depreciation as possible. And Allison, so it usually goes with the construction. I usually see the cost seg done by an engineering mindset. Do you do cost segs, or do you bring in other people to do cost segs?
Right now, Sobel actually uses 3 different subcontractor real estate appraisers who have their MAI designation, and a couple of them have the ASA designation. We've taken on a couple cost seg studies for clients, whether they be clients of Sobel or outside clients who came in, and I've worked under the MAI appraiser to do those cost seg studies. But it is very involved and requires a lot of training. So that is still something.
And I will say this up front. I recommend, if you're going to get a cost seg done, or you want a cost seg done, have it done right from the beginning.
Right.
Okay. Because I've worked with clients during the construction process, and they're like, well, just separate it the way you think best. Now, I built a fort when I was a kid. Okay. I helped somebody on air conditioning one time, but I really don't know cost seg stuff. And if you ever saw my fort, you wouldn't want to go into it because ultimately became an accountant, right? You should have somebody that knows the process involved with this. And what the aim of the cost tag is, I'll say this, and Allison, correct me where I'm wrong. The aim is to allocate the cost, generally of construction a lot of times, to its proper categories, being real estate related, machinery and equipment related, land improvements, because each of those have different lives and different depreciation methods. So I just looked at the time real quick. I'm going to send out the last poll. In the next 6 to 12 months, do you, your clients, or your company plan to do any of the following: estate, gifting? So if you can go through that, let us know if you have any other questions. We're coming up to wrapping up. Let me see if I have any other quick questions. I'm still amazed with the whole COVID situation, only because I thought it was going to have so much more of an impact, but Lee kind of shot me down with that. So I don't even know what questions to ask. Thanks, Lee.
Well, Brad, you had mentioned your daughter works in hospitality. I was reading last night, the Mortgage Bankers of America put out an article. Hospitality is starting to bounce back.
Really?
And they expect occupancy levels to be slightly over 50% by the summer. More people are getting vaccinated. They can't travel out of the country, so they're traveling within the country on vacations to go see family they haven't seen. So we're starting to see occupancy rates at hotels move upwards, which is a good sign.
And increase, and I know we're not Florida, we're not Las Vegas, Hollywood type of thing, but an increase in hospitality nationwide helps the economies all over. You know, if you're at a hotel, you've got to go to the local store, the local Walmart if you forgot something at home. You can't call Amazon, generally have it shipped to the hotel.
Right.
You can, but you know, that does help. And I'm glad to hear that, because I will say, just anecdotally, I know somebody who's a general manager at a hotel, a local one. In last April, he said, yeah, I'm at 2%. And I'm like, what's 2%? He said 2% occupancy from the prior year.
Yeah.
He said that's good because I was only 1.5 last month. But if you're telling me they're anticipating to come back up to 50%, that's just absolutely amazing. So there is from what I heard at Disney this past week, there is a great big beautiful tomorrow. Okay.
Shining at the end of every day.
There we go. And por favor, Montanga. So, all right. So we're going to close out the poll. I'm going to look to see if there is any other questions. Disney and Universal, yes, Disneyland, I heard, is opening back up. I'm not going to get into any comments on California. I know Colleen, I'm not commenting. Looking to see if there's any comments. I know that Ron also asked, he said 2 words. Monica, I want to know if you can just dispel this mystery. Monte Carlo.
And what about Monte Carlo? You mean, do we run simulations using Monte Carlo is basically running simulations.
What is a Monte Carlo simulation? Because everybody likes to throw those words around. And
Monte Carlo would be doing different scenarios, I believe, based on different probabilities of something occurring. So you have different variables, different probabilities. I don't do a lot of Monte Carlo. I do a lot of discounted cash flow, but not a lot of Monte Carlo here. We just, haven't really required it. You're bringing me back to my business days. I did a lot of Monte Carlo back then. And I know there are appraisers out there that use the Monte Carlo, but we don't use it all. We haven't had the need. We do have the capability to do it. We could do it. And if there was a client that really felt they had a situation where they have so many variables they want to look at and probabilities that they think are reasonable, then we could do it.
Okay. Because
does that help?
Yeah, because those words are thrown around a lot. I was a CFP at one point in my life, and I've heard Monte Carlo, and I'm sure people attending have heard the words Monte Carlo, not knowing what it meant other than gambling. And nobody likes to gamble on their business valuation. But we are at the 9:29 mark. What we usually do is I ask I want to thank everybody for attending. Thank Monica and Allison for speaking, but I wanted to give you guys the last word, kind of. So, Monica, if you have one piece of advice you can impart to the attendees, what would it be? And Allison's lucky. She's like, good, I get to think a little longer before
I don't know. I think, the main thing about business valuation, one, if you're going to have one, someone who's credentialed, for whatever reason it might be. Do your homework before you hire somebody. And I think also, I would say that a company's earnings are very important. If you have two companies, they're both doing $10 million. One has a $2 million EBITDA and one has a $1 million EBITDA. Which company do you think will be more valuable? The one with the higher earnings. So I think owners being sensitive to their earnings. If you're going to sell your business also, consider, if you're flowing your condo through the business, maybe take that condo off, and we're going to have to normalize the earnings and really look at the company, but earnings are very important. And but anyway, feel free to contact me if anybody just has a question. You have my email. I'm happy to.
So Allison lucked out because she gets even more of a reprieve on time, because somebody did come in with a question, but I want to say something. Adam Lipkin in our office is doing some M&A work, not evaluation, but he's trying to, do a quick calculation of EBITDA, and the EBITDA is negative. And he said to the owners, okay, what's in here that's buried? And they're like, we pay for our personal gas. And he's like, not to the tune of $200,000. You got to come clean. And in the end, people really you got to be honest with people. Monica doesn't work for the IRS, so, but she's not looking for illegal things. But somebody did ask one of the questions I expected them to ask. The other one, how much is it going to cost, wasn't asked, and I don't think you're going to answer. But generally, how long does it take to typically get a valuation on a service business done?
I would say from the time you get the information, about 3 weeks. It's about
Okay.
3 weeks. It usually stretches out to 4, but I would say 3 to 4 week time frame from the time we get the information in-house.
Okay.
We do have a rigorous quality control, which adds time to it. I don't just put together a real estate report and send it out to a client. It goes through 3 or 4 people once or twice before it goes out to our client. So you have to figure at least a week for quality control.
For peer review.
Great. So Allison, do you have any parting comments that you'd like to tell our attendees?
Just to add to what Monica said, if you are talking to a possible business valuator or real estate appraiser, and they're telling you, oh yeah, I can hit that number, run away. Run away, run away. If they can tell you right off the bat that they can hit a number for you, you're not going to receive a good appraisal, and you're not going to receive an appraisal you want to submit anywhere. The biggest thing about our job is that we are supposed to be unbiased. And if they're telling you they can hit a number, they're wrong.
That's an absolutely great comment. It's similar to people saying, I love my accountant. Really? What does he do great? He always gets me the refund I want. Okay. All right. Anyway, great comments. Allison and Monica, thank you very much for presenting. Monica, this is the second time we worked together, and you always come up with some great information. Allison, hopefully we'll have you on, if not this session, of Sobel Insights. I'm sure that we can come up with 5 questions actually on Sobel Insights. I want to thank everybody again for attending.